In the week since Brexit, stocks have been hitting record highs and bond yields have touched record lows. All this comes as companies start reporting second quarter results, and that means there's a lot of pressure on this earnings season. That's the view of Gina Martin Adams, equity strategist at Wells Fargo Security, who joins me now. Welcome, Gina.
Thank you.
Great to have you here. This is the first improvement in year-over-year earnings expected in 8 quarters.
Yeah.
So what is the risk if companies don't deliver here?
Well, first I'll have to say it's pretty rare that companies don't deliver on that quarterly beat.
Yeah.
I mean, it's for years now we've seen an increasing propensity for companies to guide significantly lower so they then beat. So your expectation is on the quarter itself, they probably beat expectations for pretty abysmal earnings growth. Though it's better than the last 8 quarters of growth, it's pretty nasty. The problem that I think we run into this earnings season is, can companies justify expectations for growth going forward? Because we see this hockey stick pattern of growth expected by analysts starting in the third quarter, fourth quarter, and then into 2017.
Right.
And we have a lot of question marks as to whether or not companies can suggest, hey, this is real, we are going to see that kind of earnings growth or not. And that, I think, is going to be the bigger sticking point for this earnings season.
And such a good point. Now that we're in the second half of 2016, 2017 really matters now, right? The revenue picture, though, a little bit more unclear. We've kind of seen some slow and steady improvement on the top line, right?
Yes, we have, especially excluding the energy sector. This quarter, we should see about 4 to 5% revenue growth on a year-on-year basis, excluding energy, which is reasonable revenue growth. And then we're supposed to see that number continue to accelerate through the next 4 quarters. That, I think, will be very, very key this quarter, because investors are pretty keen. They've figured out that companies are utilizing buybacks, they're squeezing, every ounce of productivity out of their labor force, they're not hiring a whole lot of people to create bottom line earnings growth. But where does that top line go? Because that's what creates sustainable earnings growth going forward. And I think that that's going to be incredibly important this earnings season.
When we think about sectors, the outperformers have been the defensive sectors leading the way. Is that a concern for you when you think about the market as a whole?
Usually it is, and I think it's a consequence of a few things. I mean, when you have roughly $13 trillion of global sovereign debt trading at negative yields, any kind of yield is attractive. And so the higher yielding defensive sectors in the U.S. economy or the U.S. stock market are very attractive relative to others. Normally, when higher yielding defensive sectors are outperforming, it's symptomatic of a market that's struggling. And it has been. For the last year, these sectors have been outperforming as the market's been moving sideways. You get the sense that in order to really sustainably move beyond this sideways trend in the market, we need to have more participation. We've started to see that over the last couple of days.
Yes.
But days is a very small time period to measure performance on. What we need to see is that performance broaden to greater cyclical sectors, more sectors in the market in order to justify stock prices going higher.
And given the outperformance of those defensive sectors like the utilities, what are you advising clients now where they can see value in some of those yield-oriented groups?
Yeah, I think you have to be pretty careful because they are. Many of these stocks and sectors are extremely overvalued relative to their past. In particular, investors with longer than a 6 to 12-month time horizon really need to be careful, because valuation matters more for longer-term returns than it does for short-term returns. So our view has been find yield at a reasonable price. We like telecom as an example. It is the highest yielding sector in the market, and yet it's still trading at a discount to long-term average on PE. The very opposite is in the utilities sector, where valuations appear to be getting extremely high relative to long-term average. So yield is still a theme for us. But I like yield combined with some sort of valuation lens.
On the other hand, the cyclicals or the risk-on sectors could be just starting to gain momentum. When we think about those groups, the financials come to mind, the industrials, where do you see the most opportunity versus risk?
Well, we like the industrials most. I see the industrials as still somewhat undervalued. Investors don't like them too much. There's still a tie to the energy sector. There's still some international exposure. But when you dig a little deeper in industrials, you can find some very pure domestically oriented names that don't have that much energy exposure, that maybe got sort of thrown out with the bathwater of the energy crisis over the last year and a half. So we do like the industrial sector, much better price trends in the industrial sector, cheap valuations, and what we see is beatable earnings expectations over the next 4 quarters. Analysts in the industrial sector are not terribly optimistic, and that stands out in today's environment. So we do like industrials. On the other end, we're not as keen on financials. Financials are an area where we see earnings estimates as far too optimistic relative to economic fundamentals. While valuations are very, very cheap, and the long-term investor should probably start looking into opportunities in financials, in the short run, it's just going to be tough for financials to overcome that hurdle of high expectations, quite frankly.
So many industrials creating value on their own too, split ups and strategic actions, really a lot going on in that department.
There is, and it's a means to an end, because it's been a really difficult environment for industrial companies, particularly industrial companies that have linked to the energy sector over the last several years. But you do see the industrial conglomerates are a good example of companies that are really focusing on core businesses and running those businesses to the best of their ability, and it's starting to show up in the earnings stream.
Thinking about the run to the end of the year, you have a 2100 target on the S&P. We've broken through that level. What would cause you to up that or change it in any way?
So what we do with 2100 for us is not necessarily a target. It is a fair value estimate. And what we do is we take a fundamental, sort of a grouping of fundamental factors, and we say, where are earnings going and what can we justify for valuations? And that's what we get for 2100 for the S&P 500. The combination of current earnings and valuations gets us to 2100 fair value estimate. What would change our mind on our fair value estimate is if something changes in the valuation or the earnings environment. Right now, obviously, we have earnings season. If companies come out with a much more bullish tone, we start to get a little more optimistic about the earnings outlook, that can increase that fair value estimate. On the other hand, things like greater liquidity provision around the world, increasing investor risk tolerance, tightening spreads in the high yield and high grade market can boost valuations on the index. So we look for those two things to really move. Either earnings are moving or our valuation model is moving, and that changes our fair value estimate.
Well, we'll certainly be looking closely to this earnings season and commentary in particular. Gina, thanks so much.
Sure, thank you. All
right, that's Gina Martin Adams of Wells Fargo Securities. Now it's your turn. Tell us how healthy corporate profits will be this earnings season in the space below or on the Yahoo Finance Facebook page.